All right, good evening, everyone. Welcome to the Loan Officer Training Series with the Mortgage Calculator. We'll get started here in just a moment. Tonight, we're going to be talking about effective rate lock management. Great time to be talking about this, so we'll get into that momentarily. We got the chat up on the screen there. Feel free to drop a comment there in the chat as you tune in. You can also drop any questions you may have in the chat as Jose goes through the presentation here shortly. And it looks like we're live on all the different platforms. So we'll go ahead and get it started here. What we'll do is we'll take the chat off the screen for now, but we will go ahead and again, answer any questions you have, drop them in there. So welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a lender that specializes in non-QM loans. And what we do every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern is this loan officer training series where we do a deep dive into a different loan officer training topic. And tonight's topic is going to be effective rate lock management, which is ever so important, especially right now in this rate environment that we're in. So Jose, I will let you go straight into it. Let's talk about how to manage rate locks effectively.
Good evening, everybody. Thank you for joining us for today's training on effective rate lock management. As Kyle noted, with all of this volatility that we're having in our lending environment, it is always good to go back to the basics and make sure that you are dotting your I's and crossing your T's and not leaving money on the table for a lot of the different reasons that we are going to cover in this presentation on effective rate lock management. There's some very, very critical points to consider that in the hustle and bustle of our everyday life as busy mortgage loan originators and some of us also as realtors, we may tend to forget those basic things like, dotting your I's and crossing the T's that could result in your deal falling apart. So what exactly am I talking about? Well, we'll get into it right now. First, let's add a little bit of context, right? Always like to empower my audience so that you know exactly what we're talking about. So, what exactly is a rate lock? Right? A rate lock is an agreement between a borrower and lender that allows the borrower to lock in the interest rate on a mortgage for a specified time period at the prevailing market rate and provides the borrower with protection against a rise in interest rates during the lock period. Uh, Normally, the longer the rate lock period, the more expensive the cost on the rate. Usually, you're going to see, uh, and sometimes they're the same. It really depends on the product, really depends on the moment. Uh, but you'll see the 30-day price and then the 45-day price, and usually you're going to have a difference of anywhere from a 0.125 to a 0.25 point difference in the cost of the rate for the different time periods. But like I did mention, sometimes there won't be a difference. You just have to really look at the rate sheet, make sure where you stand. Another term you're going to see thrown around, especially in my presentation here, is interest rate risk. Now, that's what we're trying to minimize when we are locking in these loans. Interest rate risk is the risk that market interest rates will rise, which will cause a decline in the value of the instrument, the loan package. So, when that happens, the way to increase the value is, I mean, if it changes one way or another, then they may charge you more for the same rate. That's how they maintain the value of the package. So if the market declined and the rates went up, then the cost of the rate will go up unless you were locked in. Pull through rate. Now, this is very important for us, definitely as lenders, because you don't want to have a low pull through rate. The pull through rate is the number of loan applications that are closed and funded by the lender versus the total number of submitted loan applications over a set period of time. And really, we're talking about locked loan applications here. I guess I should add that pull through rate is really concerned with the number of loans that you locked, and did you close all of those locks, or did you break the lock because either the file didn't get approved or whatever reason happened? The loan got canceled, it was a refi. Loan got canceled, it was a purchase. All of those cancellations could affect your pull through rate, to the point that if the pull through rate drops below a certain point, there may be a penalty placed upon the pricing of that organization. So, in other words, they're going to affect your pricing. It's not going to be as good. The higher the pull through rate, you can negotiate possibly better pricing. Lower pull through rate, you're probably going to have worse pricing. And here, the last point here, a very, very important point to consider in rate lock management, right? This is really where the management comes after you're already locked. You definitely want to keep an eye out to see what's going on with the rates, right? To see if you can take advantage of a float down, because a float down is a policy that allows renegotiating the lock once a minimum threshold difference has been reached. Usually, that pricing threshold is usually at least a 1 point betterment in pricing. Now, that's not 100% across the board. Some it could be a little higher, some it may be lower, but typically what I've been seeing is 1 point. That means that if the current pricing for the loan is at least 1 point in cost lower than when it was locked in, then there is the ability to renegotiate and be able to float down to the lower cost rate, or to the or get the lower cost for the same rate. But keep in mind, this is always going to come at a cost. The cost I've seen a lot of times is a half a point, but it could be 1 point. That's going to depend on the investor. It does vary from investor to investor, as do the float down policies also vary from investor to investor. Because remember, I mean, you're locked in. Um, and what may happen is that if they don't have a float down policy, they may end up with canceled loans because the customer says, forget about it. I don't want to do it anymore. It's not worth it. Or some MLOs that get overzealous and cancel at one spot and start somewhere else and submit and lock it out somewhere else just to try to save the money that way. That's not what we want. That's not an acceptable industry practice. That'll definitely affect your pull through rate and could cause you even to be canceled from submitting loans or put on probation from submitting loans to a particular conduit if they find out that you're doing that type of maneuver. So you definitely want to always look at the float down option instead of just straight out cancel the file, just to take advantage of pricing somewhere else that may be a little bit better. So we recently had our understanding, market fluctuations, interest rate, and what causes it. So I'm going to condense that down to one slide here, because as we discussed in that presentation, understanding interest rate fluctuations is key, right? It's not, that difficult if you just follow certain indicators and understand what you're looking at, right? Usually that information is readily available on a lot of different websites, and it does change throughout the day. So, what is interest, right? Interest is the price you pay to borrow money, and is typically expressed as an annual percentage. What are the factors affecting interest rates? This is the condensed version, right? The Federal Reserve Bank, through open market operations, sets interest rates, manages the money supply, regulates financial markets, and acts as a lender of last resort during periods of economic crisis. Right? They're going to monitor certain indicators in our economy and then make their monetary policy decisions based on those indicators, right? And what are the things that they're trying to do, right? Well, first and foremost, inflation, right? They want to keep inflation below a certain target. The target right now is 2%. So the Federal Reserve counters inflation by raising Fed funds rate which increases all other borrower costs down the line. The Fed funds are the funds that banks lend and borrow. So the ones that have an excess in capital reserve will lend the money to those that are deficient in capital reserve requirements. They'll borrow the money via the Fed funds exchange, I guess you could call it. It's an overnight type loan. Um, that definitely affects banks' cost to borrow. There are banks that are always borrowing Fed funds, so obviously that's going to be one of their standard business operating expenses. The higher the Fed funds rate, the higher the cost of money, the higher then it's going to trickle down and result in higher interest rates to everybody else. Another component that the Federal Reserve watches is the unemployment rate, because the lower the rate, that equals more people working, right? Which means hotter economy, more spending, and higher prices, right? The higher the unemployment rate, then it's the opposite. You would expect there to be a cooling off of the economy, less spending, and the prices to ease. That's the general theory there. So in essence, yeah, the Federal Reserve is trying to increase the unemployment rate when they're increasing the cost to borrow because they want to slow down the economy. A lot of things come into play. And the last bullet point there is the gross domestic product, which is basically the output of the U.S. economy, taking into consideration both the manufacturing sector and the services sector. That is our GDP. So the GDP determines our ability to pay, right? The better the gross domestic product, we have a better economy. We should be operating at some surpluses. The country's not gonna need to borrow. But if we do need to borrow more, the rate of the instrument will need to increase, right? Because in borrowing more, we're basically issuing more bonds, or the U.S. Treasury, I guess, is issuing more bonds, Treasury securities, more supply. So more supply means you're gonna have a lower value, and then to bump the value back up, you have to increase the yield. Higher yield makes the instrument worth more, but unfortunately means higher interest rates to our consumers. So again, make sure you check out that training for that show that we had on understanding interest rate fluctuations for more detail on this. But definitely, you have to have a little bit of knowledge so you can follow the reports. So, what are some strategies for effective rate lock management, right? Well, analyze the market trends and economic indicators daily, the ones we were talking about, and share these with your borrower. We always talk about empowering the borrower. It should really be a decision made by the borrower where you are basically enlightening them to the need, empowering them with some knowledge so that then they can analyze everything and tell you what they want to do, if they want to lock in now, if they want to lock in later, how they want to do it. But again, this leads very important to the second bullet point. Early in the process, not like when you're approved, but early in the process, before the loan is disclosed, you want to communicate to the borrower the need to lock the rate and confirm when the borrower decides to lock the rate. They may like the rate that they have right now and the cost. So as soon as the file is disclosed and they sign, and you sign, and the file is set up and registered in the portal where it's going to be submitted, then we can lock in that file, right? If that's what the customer wants. Or maybe the customer says, no, Jose, I'm following the market or whatever they're looking at, and I really rather wait a little bit more. I want to wait right till before it's going to be ready to close to lock it in. Okay, that's fine, but you want to make sure that that communication is in writing, like via an email and all that kind of stuff, because what you don't want is for the borrower to say, Jose, you never told me on May 28th that I should lock my loan. And now look what happened. It's going to cost me one more point. And then I can go back to the email and say, yep, here's the email where I initially asked you. And here's a follow up email where I said, hey, listen, it's been a few days. There's volatility. Do you still want to wait, or what do you want to do? And here's your reply in both instances that you wanted to wait. So, you're clear of that one, but you want to make sure that you are not the reason that the borrower did not lock. Because most borrowers, I mean, unless they're like really experienced borrowers, may not be aware of how the process really works, right? You're assuming they know, but they don't know. And they're assuming what they're usually assuming is that when they get that loan disclosure package and it has a rate, they're assuming that's my rate for this throughout this whole process, unless you tell them otherwise about when do you want to lock the rate. That's why it's so important to communicate. Um, Give yourself a cushion if locking in right after the loan disclosure, especially for purchases, and lock in for 45 days and not 30 days, as the cost to extend the rate is 2 to 3 times higher than the cost of the original lock. So, what do I mean by that? Okay, you go to check out on the rate, and it says, 30-day lock at 7% costs a half a point, point 0.5. Then it says the same interest rate for 45 days may cost 0.625, right? A 0.125 more for the extra 15 days. However, if you go to extend that lock, it could easily cost you 0.375 and more, depending on what you wanted to do. If you wanted to do, 15 days, right? A lot of times they're costing 2, 3, 4, 5 basis points. They could cost, depending on the investor. So be aware that, typically we're seeing the cost to extend being 2 to 3 times higher than the cost for the original cost of the extra days, especially on purchases. I mean, unless you received an appraisal waiver on the file, there's a good probability that it's going to be tough to close it in 30 days. So you would probably want to, if you're going to lock it in from the onset right after disclosure, you probably want to do a 45-day lock, not a 15-day lock. Now, my next bullet point is really important on, when you do your proper consultation of the borrower, because you want to make sure that you properly analyze their credit, their income, and property type prior to requesting the rate lock. Why? Well, what if you lock it in at disclosure, you don't have all the income docs, and all of a sudden the income comes in different. DTI is now not 35, it's 48, right? It has a higher cost. Or worse, something happens when you do get the documentation or the review that now the borrower doesn't even qualify for that program. Now you got to go through another program. Maybe now you got to go bank statement or who knows what. And maybe that conduit doesn't have that program. So now you got to cancel the loan there and take it somewhere else. And that's going to affect your pull through rate. So don't be overzealous in your eagerness to quickly lock in the rate and then mess it up for yourself later when you have to make all these changes. And most importantly, it's not the last one because it's the least important. It's probably the one that ties in all of them together. Make sure you manage the borrower expectations throughout the process. That's a great strategy for effective rate lock management and just the loan in general. Keep them abreast through every milestone change, anything that's happening through the file, just so that they're aware of what they can expect. Stuff like this, stuff like with the appraisal, with the income, with the rate lock, different things, and also obviously not related to rate lock, but with the closing, right? The closing date. If there's going to be any kind of delays or anything like that, make sure that you please keep the borrower informed throughout the process. That's going to make it a lot easier for you, because what if the delay is caused by the borrower, not by you, and they're very well aware because you've been letting them know throughout the process what you needed, when you received it, if it was good, if it was bad, the turnaround time in underwriting, the turnaround time to review, the turnaround time for the appraisal, all the different things. And then all of a sudden you need to get an extension due to an unforeseen delay, but the borrower already knew what was going on, so it's not going to be an issue for you when the borrower sees the LE with the additional cost to extend the rate, right? So make sure you manage those borrower expectations so you can keep your deal together. Now, what are some challenges and the end results of what can happen, right? I got the challenge in black and the negative result in red. Well, the first challenge is you're talking about market and interest rate volatility, right? And I mean, if you look at the last 30 days activity in the 10-year treasury, you're going to know what I'm talking about in volatility. Well, market rate and interest rate volatility could result in interest rate spiking, and the borrower no longer qualifies at the higher rate if you never locked it in, right? This is now this, I guess I should backtrack a minute, and this page is more like what can happen if you don't lock in the rate, right? That's why it's a challenge in rate lock management. So the first would be market and interest rate volatility causing an interest rate spike where the borrower no longer qualifies at the higher rate and maybe can't afford to buy it down to the lower rate, right? So definitely you do not want a borrower who now is disqualified from the loan because you didn't lock in the rate and you were at 49.8% DTI and now you're at 53 or 54. So keep an eye on that. What is another challenge would be revision of guidelines. You didn't lock the loan in, and now all of a sudden they eliminated the 85% LTV DSCR, for example, or they eliminated the use of short-term rental on the DSCR, or who knows what can happen with when guidelines are revised. A lot of different things can happen where a program could be totally eliminated. So in this case, the conduit that's lending the money, they are tightening the guidelines to reduce interest rate risk on their part. Remember, interest rate risk is what happens, for example, to their value of their portfolio when interest rate changes. What's the value of the portfolio of loans, or that particular value of that particular loan, which is already locked in? So sometimes what they'll do is they'll revise guidelines and make them tighter, right? Tightening of the guidelines reduces the risk. Hence, the price on that loan or on that loan type could remain the same because you lowered the risk. However, so that's good for the borrowers whose guideline tightening didn't disqualify them from the loan, right? That's good for the borrower with the high credit score, for example. But the one who now maybe is below the minimum credit score, maybe he was at a 640, now they raised it to 660, he's out of gas, right? And that's intentional because they want to increase the value of the portfolio, and the way to do it is reduce the risk, and that's one of the ways to do it. Another risk, which I mentioned here, is the total elimination of programs. Over here on the second bullet point, we're talking about revision of guidelines. The third bullet point, we're talking about loan programs can actually disappear if you did not have the loan locked prior to their making the decision to eliminate that program. You all have seen the emails come through where programs get eliminated. Everybody whose loan is locked will be good. Sometimes they'll tell you, make sure you don't have to get an extension or we're not going to extend it. Or sometimes they will. It's really case by case situation. But Now, I have seen in rare occasions, in extremely volatile situations, where a conduit may actually decide to cancel rate locks and not honor them. Obviously, they're going to lose a lot of goodwill in the industry when they do that. But I mean, the end result could be they're allowing the borrower to close on a bunch of loans that they're just going to lose money on one after the other when they go sell it into the secondary market. So at that point, the investor, in this case, a conduit, right, that's amassing the loan packages, is going to have to decide what is worse for our organization. Is it the negative goodwill that's going to be created when all these rate locks get canceled, or is it the fact that we're not going to lose 50 million or 20 million dollars or whatever on that $100 million loan package? That's a decision that has to be made. But and usually the borrower that's not locked in is the one that's going to suffer. So don't be that MLO to cause that to happen. And another challenge is higher cost of not locking in your loan is higher cost. What do you mean by that? Well, okay, you didn't lock it in at 7%, and that was the maximum rate they qualified for, right? So now 7% instead of costing 0.5, now 7%, we had a serious meltdown. Now 7% costs 2.5, right? Or maybe it's not even available anymore as an interest rate option, which is even worse. But if it's 2.5 the cost and the borrower had the precise funds for a 0.5% in a loan discount and they don't qualify at a higher rate, what are you going to do? You can't go to a lower rate. So usually what happens at this time is, cutting of commissions, right? To try to save the deal. But how much commission is really being made in the loan to make up a 2% cost difference? I don't think there's 2% there available to give up and still save the deal. So again, the best solution is don't get caught in that situation and make sure that the loan is locked. Because in this case, if the borrower has to increase their down payment or closing costs to qualify at the higher rate, and they'll not be able to do it if they don't have the additional resources. And the end results on not successfully meeting these challenges is that the borrower becomes upset, cancels the loan, vows never to conduct business nor refer a loan to the MLO nor the company that the MLO was employed with. And then on top of that, besides all the vowing they're going to do, they may go out into social media and just start giving you bad reviews left and right. And you know how those really spread like wildfire. People aren't so apt to talk about good things really fast, but tell you, once it's something negative, they're really fast to pull the trigger and let everybody know about how upset they are and how bad the service was. Conversely, in our last slide here, right, there's our happy MLO, right? And what did he do there? He hit the target. He hit the bullseye there with his rate lock management, and everybody's happy. So, what are the benefits of effective rate lock management? Well, you're going to minimize interest rate risk for the file. That's what it's all about. Minimize the increase in the cost of the rate, minimize the elimination of guidelines, minimize the increase in the rate. Just all these things that are associated with interest rate risk, you're not going to have to worry about. And then, especially if you want to be considered, right, a loan consultant, so you could get all these referrals in the future. That's why all these are so important. You want to be able to provide certainty to the borrower's financial planning, right? They thought it was going to be one rate on that property. It's an investment property. They already calculated their rate of return on their equity investment, and it was calculated at 6.75%. And now, for a lot of different reasons, is at 8%. And the buyer is even wondering if he still wants to close on the deal because now it's not as sweet as he thought. And then that really ties in together with increasing borrower profitability. First is the certainty, right? They want to be able to plan. And then is the profitability, right? They're gonna have their financial stability, and they're gonna have their increased borrower profitability at that 6.75 rate that they thought they were going to get from the beginning. And if you would have locked it in by the time the file was disclosed, that 6.75 would have been available. But unfortunately, what happens sometimes is the MLOs playing the game of trying to lock it in after it's already approved, ready to go for only 15 days. I mean, that's going to come back and bite you so bad. That's a double-edged sword. The best solution is clear communication with the borrower on what they can expect and what they're going to get, and be able to deliver. So, and then the reason for his smile, right? The last bullet point, which I broke down into four individual points there. The reason for his smile is increasing overall MLO experience due to, right, higher earnings, right? So I mean, it just makes sense. You're going to make more money if you have less deals falling apart due to rate lock issues. You're going to have higher earnings due to increased referrals from satisfied customers. So, no rate lock issues equals higher earnings. That same satisfaction that the customer got is going to result in higher earnings because you're going to get more referrals. And then the MLO also is going to have higher earnings because you're going to be spending more time on production and closings and less time dealing with borrower issues and complaints. And last point, you're going to have a more positive business outlook from the increased satisfaction of being a successful loan consultant. You're going to be happy doing what you do. If all that happens to you all day long is people beating up on you because of the rates not what you promised them it was going to be, then you didn't do your job in effective rate lock management. You're going to have a lot of upset people, and you're not going to have a very sustainable MLO career. So definitely, if you want to be like our smiling MLO there, hitting the bullseye, pay attention to what we talked about here in this presentation regarding effective rate lock management strategies, because it's such a simple process if you are aware in the beginning how it needs to be done and not waiting till the last minute and getting surprised.
All right. Great. Okay. Looks like we got a couple questions. So let's pull them up here. 1 second. First question is, in the timeline, when is the best time to lock rates?
Well, again, that goes with communicating with your borrower, right? Communicating with the borrower, empowering them, explaining them the different factors that we talked about that could affect the interest rate, that could cause it to fluctuate, and then ask the borrower when they want to lock it in. Because, for example, we're going over the file that's going to get disclosed tomorrow. I'm telling the borrower, hey, Mrs. Barr, you're gonna get the disclosures either tonight or tomorrow. It's pretty much here. It looks like it's gonna be at 7.5% rate at a cost of 1 point. Are you fine with that? Right? They should be, because they already agreed to it. I'm just updating them now because they may have accepted a quote. Now we've updated the cost. We're about to disclose a file. I'm reconfirming that the borrower is good with that rate. Then I'm going to ask them, do you want to lock it in now, or do you want to wait? And if you're happy with the rate that you have now, we can lock it in, and then you can be guaranteed that you're going to get that rate, and let them decide at that point what to do. Now, also depends on the transaction. For example, if it's a new construction and the home's not going to be built for 6 months, you're certainly not going to do a 6 month extended rate lock. Some investors do offer those up to 6 months, but they come at a really high cost. So if it is new construction, then you may want to discuss that. If it is an option where you're submitting the loan to lock it in for 6 months, then discuss it with the borrower if that's your scenario, and make sure that you let them decide after empowering them with the relevant information that they need to decide. So again, the best time to log it in is when the customer wants to log it in. If they know that's the rate that they want at application, then I would strongly, especially on a refi, I would strongly recommend empowering the customer and then locking it in so you don't have any issues there.
All right, let's see here. Another question. Is it required to be locked while it's being sold in the secondary market?
Oh, great question. That depends. It depends from investor to investor, but that is a great question because it brings up a very critical component of rate lock management is exactly that also. Some of the conduits that we sell the loans to are going to require the rate lock to be good through their purchase of the loan. Now, that's not the majority. That's actually the minority of the cases require that. Most of them will only require the lock to be good through their receiving the package through. So the package gets signed, title company reviews it, everything's good. They upload it to the investors portal. 9 times out of 10, that right there stops the rate lock expiration clock from ticking. But not every case. So be aware where you're sending the loan. And if they have an out of the ordinary policy towards that, which some do, then your lock has to be extended or locked in to take into consideration those extra 5, 7, in some cases 10 days that it may be. And if it's a nightmare that something was missing and you got post closing conditions until they purchase it, it could be 2, 3 weeks until that loan gets purchased and the lock has to keep getting extended.
Okay. I don't see any other questions, so I think we can go ahead and wrap it up. Great presentation there, Jose. Important to keep in mind, especially in this rate environment. So we appreciate everybody tuning in. Remember, we do this Tuesdays, Wednesdays, Thursdays at 7 p.m. Eastern, where we go through a new loan officer training topic. So we will see you tomorrow, 7 p.m. Eastern, for the next episode of the Loan